Welcome to Sheen Research, your strategic partner in comprehensive investment analysis.
Today, we are launching an extensive investigation into the financials of a true global energy giant, Petróleo Brasileiro S.A., or, as everyone knows them, Petrobras.
That's right. We're going through their latest unaudited financial statements, specifically for the third quarter of 2025, so the 3- and 9-month periods ending September 30th.
And this report gives us a really fascinating window into how a massive integrated oil company navigates, well, some pretty serious global volatility.
And volatility is definitely the word for it. When you look at the big picture, you're analyzing a company that's not only a global player, but is also, deeply tied to the Brazilian economy.
All while facing immense pressure on its main commodity.
Exactly.
And that pressure is the critical piece of context you have to grasp right from the start. Management's own commentary really hammers this home. They were battling a major headwind.
Which was the price of oil.
The price of oil. Brent crude prices had dropped by about $11 per barrel over the last 12 months.
$11. For a company of this scale, that's not just a small dip.
It's a severe, almost systemic challenge to your entire profitability model. Your revenue is directly pegged to that price.
So that really sets the stage for our analysis today. How did they possibly compensate for an $11 per barrel drop in their primary product?
Well, according to the CFO, Fernando Melgarejo, the answer was a pure operational counterpunch.
So they couldn't control the price, so they controlled what they could.
Volume? Exactly. They leaned entirely on volume and efficiency. They didn't just meet their targets, they actually set new operational records.
Okay, so what kind of numbers are we talking about?
They announced achieving oil production over 2.5 million barrels per day.
2.5 million every single day.
Every single day. And this isn't just a small, incremental gain. This is the result of a sustained, concerted effort across their entire operational fleet.
And I think the details of how they did that are really important because that tells you where the future growth is coming from.
It does. They specifically pointed to improved efficiency and a significant reduction in production stoppages. But the real star of the show was the FPSO Almirante Tamandaré.
Right. The new floating production unit.
That FPSO is a showcase of asset optimization. I mean, reaching its peak production is what you'd expect, but they claimed it surpassed its nominal capacity.
Surpassed it.
Yes. And that signals incredible capital efficiency. These pre-salt FPSOs are the engines of Petrobras's production for the next decade, and squeezing every last barrel out of them is how you directly fight back against a lower price environment.
So the narrative is pretty clear then. When prices go down, you sell more of the stuff you can produce most efficiently.
That's the playbook.
Okay, let's look at the financial scoreboard that, supposedly validates this whole strategy. What are the quick glance highlights from the 3Q25 results?
For any investor trying to cut through the noise, the core profitability numbers are what you look at first. So adjusted EBITDA, and this excluding those one-off events we'll have to dissect later.
Like the clean number.
The clean number. It hit a very robust $12.0 billion. That signals excellent health in the underlying day-to-day operations.
And how did that $12 billion translate down to the bottom line?
Net income, again, adjusted for all the non-recurring items, came in at $5.2 billion. And crucially, the cash generation was just spectacular.
That's what really matters.
It is. Operational cash flow, or OCF, stood at $9.9 billion.
Nearly $10 billion in cash from operations in a single quarter.
And after all their working capital needs and maintenance CapEx were paid, they delivered a free cash flow, or FCF, of $5.0 billion for the quarter.
$5 billion. And that FCF number, that's the lifeblood. That's what pays for dividends and all
Right.
the future growth spending.
It's everything.
Before we get deeper into the P&L, there was another number they highlighted that I think is worth mentioning, the societal contribution.
Yes, their economic impact within Brazil. The report pointed out that they paid $68 billion in taxes to the federal government, states, and municipalities.
And that was just in 3Q25 alone.
In one quarter. And that figure isn't just a line item. It really underscores their systemic importance to the entire Brazilian national budget and economy. And of course, that strong cash generation also fueled some pretty substantial returns for shareholders.
It did. The board approved our $12.2 billion in dividends just related to these 3Q25 results. That shows a lot of confidence in the sustainability of these cash flows, even while they're ramping up their investments.
Okay, so we've got the headlines. Now let's move into the detailed financial trends. We really need to dissect the revenue, the cost structure, and the margins.
And this is where comparing the quarter to the 9-month period becomes really, really telling.
So let's start at the top line. Sales revenue.
For 3Q25, sales revenue was $23,477 million. And if you look year over year, that's actually a slight increase from the $23,366 million in 3Q24.
So that fits the CFO's story. The aggressive volume increase helps stabilize the quarterly revenue, basically stopping a massive drop despite the lower Brent price.
It plugged the hole, exactly. But what happens when we pull back and look at the year-to-date figures? That's where the pressure from that lower price environment has to show up, right?
It becomes inescapable. For the full 9-month period ending September 30th, the 9M25 number, sales revenue was $65,587 million.
And how does that compare to last year?
It's significantly down from $70,601 million reported for the same period in 2024.
So that's roughly a $5 billion reduction.
It is. And it confirms that while their production efforts in Q3 stabilized that specific quarter, the overall average oil price for the first 9 months of the year was materially weaker than last year. It averaged about $12 a barrel less.
Okay, let's move down to gross profit. This is where we should really see the pricing pressure hitting the manufacturing side of the business.
And you do. Gross profit was $11,217 million in 3Q25, which is a noticeable step down from the $12,005 million they posted in 3Q24.
And that decline is a direct result of the price compression.
It is. Your input costs are staying relatively stable, maybe even rising a little, while the price you're getting for your crude and refined products is dropping because of global market conditions. That naturally squeezes your gross margin.
But here is the major financial puzzle that this earnings release created. Despite that dip in gross profit, the net income attributable to shareholders, it actually improved in the quarter.
It ticked up.
Yeah, it went up to $6,027 million in 3Q25 compared to $5,870 million in 3Q24. How does that happen?
This is the first big clue that there are powerful non-operational factors driving the bottom line. When net income defines a compression in gross profit, it means you have some massive tailwinds blowing below the operating line.
And those tailwinds, they become almost explosive when we look at the 9-month total.
It's incredible. The 9M25 net income wasn't just, it shot up to $16,735 million.
$16.7 billion. And what was it last year?
Only $10,308 million.
So that's a massive 62% jump year over year. What on earth accounts for that kind of growth when sales revenue was actually down?
That $6.4 billion surge in 9-month net income is, it's the central story of this quarter's results. And it's driven overwhelmingly by two factors we're going to have to detail in depth. Favorable foreign exchange, or FX, gains, and massive favorable one-off events, particularly legal and accounting reversals.
So this is why analysts have to be so careful. You can't just model future recurring earnings based on that huge 9M25 number.
You absolutely cannot. It's full of non-recurring items.
Okay, before we get to the one-offs, let's just confirm the sequential performance quarter over quarter, because that speaks to the efficiency gains.
Right. So adjusted EBITDA surged 26.9% just from Q2 to Q3. It rose to $11,728 million in 3Q25 from $9,242 million in 2Q25. That's very strong sequential growth.
Exceptionally strong.
It is. And that huge jump confirms two things. First, the success of their increased volume and export strategy.
Yeah.
And second, the benefit of sort of cleaning up the balance sheet.
What do you mean by that?
Well, 2Q25 was impacted by some specific operational charges, particularly a big provision related to something called the Jubarte Production Individualization Agreement, or AIP.
So when those charges were gone in 3Q25?
The underlying operational profitability just shines right through.
And the margin reflects that immediately. The adjusted EBITDA margin for 3Q25 was 50%.
A highly respectable figure.
Yeah, and a 6.0 percentage point improvement from the 44% they reported in 2Q25. It shows that the cost control efforts were really working during the quarter.
Now let's slip to the other side of that. Let's look at the cost structure, which helps explain that gross profit pressure we mentioned earlier. Cost of sales totaled $12,260 million in 3Q25.
Which is up 7.9% compared to the $11,361 million in 3Q24. So we need to know where that extra expense is coming from.
Let's break down the components. What jumps out at you in the 3Q25 cost of sales?
Raw materials and products for resale were the biggest piece at about $5.9 billion.
Right, but the most important structural shift came from depreciation, depletion, and amortization, DD&A.
DD&A, how much is that?
It hit $3,297 million in 3Q25.
And how does that compare to the prior year?
It's a staggering 39.6% increase over the $2,362 million they recorded in 3Q24.
Wow, almost a 40% jump.
And this is a crucial and actually a very healthy signal for the long-term investment case,
How is a huge jump in an expense a healthy signal?
because a sharp jump in DD&A strongly suggests that those major multi-billion-dollar assets, those FPSOs we were just talking about, have been fully built, delivered, and are now in operational service.
Ah, so they're officially on the books and being depreciated.
Exactly. They are now generating immediate revenue while also increasing this non-cash expense.
So it's the cost of success then. The capital spending is finally translating directly into productive assets.
Precisely. The third major component was production taxes, which were pretty stable at $2,788 million.
Okay, what about operating expenses?
On that side, total operating expenses actually declined year over year.
Right.
They came in at $3,241 million in 3Q25, down from $3,605 million in 3Q24, which further reinforces that cost control story.
Can we break those down just briefly?
Sure. Selling expenses were $360 million. General and administrative were $501 million. And crucially, exploration costs were cut way back,
How far back?
down to $248 million. That's a huge drive from $406 million in 3Q24.
And that decrease in exploration, that seems strategic.
It is. It supports the view that Petrobras is pivoting its strategy away from, pure frontier wildcat drilling and more toward accelerated development and exploitation of its already proven massive pre-salt reserves.
Okay, now for the key. The item that unlocked that huge net income number we were puzzled by earlier. Net finance income or expense?
Right. The company swung dramatically here. They went from a net finance expense of $281 million in 3Q24,
So a cost.
a cost, to a net finance income of $271 million in 3Q25.
An income. That swing alone is a $500 million reversal on the bottom line.
It's massive. And the primary driver was foreign exchange gains and inflation indexation charges. Petrobras realized a gain of $976 million in 3Q25.
$976 million. How does that compare?
It just dwarfs the $109 million gain they had in 3Q24. This is highly volatile, it's non-recurring, but it's incredibly impactful on the reported numbers.
And this gain wasn't operational at all. It was purely currency fluctuation.
Absolutely. The source was a hefty $1,068 million gain derived from the fluctuation of the Brazilian real versus the U.S. dollar.
Can you walk us through how that works?
Sure. Petrobras has massive amounts of U.S. dollar-denominated debt on its balance sheet. When the real strengthens relative to the dollar, the liability, when measured in Brazilian reais, actually shrinks.
And that shrinking liability gets recorded as a financial gain in their U.S. dollar-based statements.
Exactly. It's what you'd call paper money, not cash flow, but it gives a significant boost to your reported earnings.
It's essential, though, to put that into context with their actual interest costs.
Oh, yes. Their core finance expenses are still substantial. Interest on their finance debt was $592 million, and the unwinding of discount on lease liabilities added another $678 million in expense.
But their CapEx program actually provided a bit of a benefit here, didn't it?
It did. They got a $530 million benefit from capitalized borrowing costs. This is where interest paid on debt that's used to build new assets can be added to the asset's value on the balance sheet, rather than being expensed immediately on the income statement.
So that finance income swing is precisely what allowed the reported 3Q25 net income to look so strong. It basically covered both the drop in gross profit and that big increase in DD&A.
It completely shielded the results from the operational pressures. And it leads us directly into the critical discussion we need to have about the impact of one-off events.
Right, we have to formalize this analysis of what's recurring profit versus what's just a non-recurring gain.
Let's do that. These adjustments are absolutely vital for anyone trying to model the company's forward earnings power.
Okay, so let's look at the difference between the recurring and the reported net income. How big was the impact?
Net income, excluding all the one-off events, was $5,261 million in 3Q25.
5261.
Right, but the net income including them was $6,053 million.
So that means the one-off events provided a net positive contribution of, what, $792 million to the quarterly result?
Exactly, a nearly $800 million boost. The gross impact of all the one-off events they recognized was actually $11,199 million.
Okay, what was the single biggest positive driver in that billion-dollar-plus figure?
The largest driver was something called impairment reversals, net. This contributed a $289 million gain.
That's a highly technical accounting term. Can you break that down?
Sure. An impairment reversal means that assets that were previously written down in value because their future cash flows looked uncertain are now seen as financially viable again, so you write their value back up.
And where did this significant reversal happen, and why did management decide to reverse it now?
This was focused almost entirely on the Complexo de Energia Boaventura. It's a set of refining and utility assets. And the trigger was a concrete strategic decision by management.
What was the decision?
They approved a project and, more importantly, signed the main contracts needed to complete the complex and integrate it with the nearby Duke de Caxias refinery, also known as Reddick.
So this wasn't just some speculative paper shuffling. It was triggered by a real-world commitment to actually put these assets to work.
Precisely. That commitment to integration increased the estimated future cash flows from those assets. They reassessed the value using a present value method with a discount rate of 8.1%.
So that $289 million gain not only padded the Q3 results, but it also suggests a renewed long-term faith in optimizing their existing downstream infrastructure.
Which has been undervalued for a while, yes.
We should also probably mention the items that didn't happen this quarter to contrast with prior periods.
Good point. For example, the effect of a tax transaction on net finance income was 0 in 3Q25.
Which is a big difference from 3Q24.
A huge difference. They had a $110 million gain from that in 3Q24. The absence of that this year just reminds you that these kinds of windfalls are inherently transient.
And what about the Jubarte agreement?
The losses related to that Jubarte Production Individualization Agreement, the AIP, were minimal this quarter. Just a $32 million loss, which is a huge reduction from the much larger charges we saw in the previous quarter.
The power of these one-offs, combined with those FX gains, it's most obvious when we go back to that year-to-date trend.
This is where you see the true financial drama of 2025. For the 9-month period, the net effect of all these one-off events was a massive $5,105 million gain.
A $5 billion gain. And what was it for the same period last year?
For 9M24, the total net effect was a staggering $8,180 million loss.
Wait, that's a swing of over $13 billion year over year, just from non-operational, non-recurring items?
It's a phenomenal swing, $13.285 billion to be exact. And this confirms that the majority of that recorded 62% jump in total 9M25 net income. That $16.7 billion number.
A huge chunk of it.
A huge chunk of it is directly attributable to these favorable legal and accounting events and the foreign exchange dynamics, not from operational cash flow improvements alone.
And that's critical for investors. Your models based on underlying operational cash flow will look dramatically different from models based on just the reported net income.
They will be worlds apart.
Okay, that provides the necessary context on the, let's call it the financial engineering of the quarter. Let's shift to the operational engines. Let's dedicate some real time to segment performance, starting with the heart of the business, exploration and production, E&P.
E&P is the profit driver, and it showed really strong sequential momentum. Gross profit for E&P hit $8,559 million in 3Q25.
Which is a solid 9.7% increase just from 2Q25.
Right, from $7,803 million.
And the operating income increase was even more impressive. It rose 31.0% to $7.8 billion in 3Q25. That indicates a fantastic quarter for profitability. Why the huge spike?
Again, it's that combination of record volume, which we've already covered, and the timing of specific expenses.
The Jubarte provision again.
Exactly. Operating income benefited greatly from lower expenses in Q3 because that significant provision for the Jubarte AIP had already been taken in Q2. So Q3 was structurally cleaner, which allowed the full force of the revenue increase to hit the operating line.
Let's focus on the E&P metric that I think matters most to investors. Lifting costs. This is the cost per barrel to physically pull the oil out of the ground. How efficient is Petrobras?
This is a bit of a nuanced story in 3Q25. The total lifting cost for Brazil was $6.30 per barrel of oil equivalent.
$6.30.
Yes. And this is up 5.6% compared to the $5.96 per barrel in 2Q25.
Oh.
So on the surface, rising costs kind of challenge that operational excellence narrative.
Yeah, so why the increase, especially when they're talking about efficiency? Is this a warning sign for their profitability?
The increase is structural, and you could argue it's acceptable. The pre-salt lifting cost was the main upward pressure. It rose 11.1% to $4.26 per barrel.
$4.26.
And that was attributed to generally higher cost per barrel and the greater share of deep water fields in the production mix.
Okay, so think of it this way. Their cheapest oil is getting slightly more expensive because they are pulling a higher volume from deeper, more complex, and therefore higher cost pre-salt fields.
That's a perfect way to put it. This increase is a direct consequence of their strategic shift towards higher volume production, even if it's marginally higher cost.
That context is vital. It's a trade-off. A little higher cost per barrel for much higher total volume and much higher reserve quality. Now, what about the mature post-salt fields?
This is where the true efficiency gains really shine. The post-salt lifting cost showed a 5.4% decrease. It settled at $16.17 per barrel.
And that was driven by targeted operational improvements.
Yes. Lower maintenance losses, the successful ramp-up of the FPSOs Ananeri and Anita Garibaldi, and the startup of 5 new wells in the Campos Basin. They are demonstrating an ability to squeeze more efficiency out of even their mature assets.
So the overall lifting cost, including leases, which is another key metric, it increased only modestly.
Correct. Lifting costs plus leases increased just 1.7% to $8.97. And given the context of increased complexity and record volume, keeping that total cost under $9 a barrel is highly competitive globally.
Especially for a deepwater operator.
Especially.
Okay, let's move to the downstream side. Refining, transportation and marketing, or RTM. How did this segment perform in the quarter?
RTM gross profit reached $1,613 million in 3Q25. That was a substantial increase of $404 million over 2Q25. Refining really benefited from sequential improvements in product crack spreads.
To understand the underlying operational health, though, we need to filter out the noise of fluctuating oil prices and inventory effects.
Absolutely. And if we do that, if we exclude inventory turnover effects, the underlying gross profit would have been $1.9 billion in 3Q25.
1.9. And what was it in Q2?
It was $1.5 billion in 2Q25. So that shows a very healthy sequential improvement in the core refining margins.
Was the cost environment stable within refining?
Remarkably so. The refining cost in Brazil remained highly stable at $2.97 per barrel in 3Q25. That's a negligible 0.3% increase quarter over quarter.
And maintaining stable costs while your inputs are volatile is a real testament to operational discipline in their refineries.
It really is.
What about the pricing for their finished products?
The average price of basic oil products in the domestic market was $84.54 per barrel. Now, while that's strong, we have to note it was down 4.0% compared to 3Q24's price of $88.10.
And that softness in domestic product pricing, that's likely where you can see the political and regulatory pressure to keep domestic fuel inflation contained.
That's most likely what's reflected there, yes.
And what does the long-term capital efficiency look like for RTM?
The return on capital employed, or ROCE, trend showed definite softening. RTM's ROCE dropped to just 1.0% for the last 12 months ending 3Q25.
1%. What was it before?
It was down significantly from 3.2% for the 12 months ending in 3Q24.
So that suggests that despite the good sequential improvement in Q3's gross profit, the overall returns generated by that massive capital base invested in RTM assets are currently under severe pressure.
It's likely due to a combination of depressed product prices and the high capital intensity of the refining business.
Okay, finally, let's look at the gas and low-carbon energy segment, GNLCE. This represents their push for energy transition and diversification.
This segment actually saw its adjusted EBITDA decrease to $203 million in 3Q25, which is a 14.0% drop compared to $236 million in 2Q25.
And was that drop primarily due to gas prices?
Yes, softer commodity pricing was the main culprit. The sales price for natural gas in Brazil fell 7.6% quarter over quarter. It moved down to about $54 a barrel equivalent, or $9.13 per MM2.
Which was probably expected, given that gas prices often lag oil prices.
Exactly. It was anticipated given the broader energy market trends.
But the positive story here, and it's a strategic one, is the emphasis on fixed, predictable revenues in the power sector.
That is the key insight for GNLCE. The fixed revenues they generate from power auctions nearly doubled. Increased dramatically by 99.9% to $59.94 million in 3Q25, up from just under $30 million in 2Q25.
And that growth in fixed power contracts is crucial. It provides a reliable hedge against volatile commodity sales and signals that management is serious about building a less cyclical portfolio through low-carbon energies.
It's a key part of their long-term strategy.
Okay, so we've established the operational engine is running at full capacity, and the financial results are getting a big boost from non-recurring gains. Let's pivot now completely to the future. Let's analyze Section V capital structure, CapEx, and liquidity. This is where the company is actually deploying capital for growth.
And this is arguably the most strategically important section of the entire report. Management has their foot firmly on the accelerator pedal. Total cash CapEx was $4.9 billion in 3Q25.
$4.9 billion in one quarter. But the year-to-date figure is what really signals the commitment.
It is. Total cash CapEx for the first 9 months of 2025 hit $12.9 billion.
$12.9 billion. That is a massive number. It's a substantial 26.6% increase compared to the $10.2 billion they spent in the same period of 2024.
It is.
That level of spending implies a profound confidence in the long-term price of oil and the viability of their pre-salt projects.
It does. It confirms a build-it-now mentality to lock in future production capacity. The E&P CapEx, which is the vast majority of the spending, was $4,670 million in 3Q25, up 25.5% sequentially.
And the allocation of this capital reveals the company's #1 strategic priority,
Which is the Santos Basin pre-salt. $2.7 billion was dedicated specifically to production development there.
Let's detail those specific FPSO projects because these are literally the foundation of the company's entire production profile from 2026 onwards.
This $2.7 billion is funding the manufacturing and installation of several colossal floating production, storage, and offloading units. We're talking about the FPSOs for the Buzios field.
P-78, P-79, P-80.
P-82, P-83, and also for Atapu and Sepia. These are not incremental projects. These are absolute game changers.
Give us a sense of the sheer scale we are discussing. What kind of capacity are we expecting from these units, and when are they slated to come online?
Well, the P-80, P-82, and P-83 units that are planned for Buzios, they are each designed to handle a production capacity of 225,000 barrels per day.
Each 225,000 barrels a day from one ship.
From one ship. So if you factor in all the additional units and the associated gas processing capability, you are talking about hundreds of thousands of new barrels of production coming online.
And the timeline?
The scheduled startups are concentrated between 2026 and 2027. This aggressive CapEx today ensures that when their current fleet of ships begins to naturally decline, this new wave of pre-salt mega projects will step in to maintain or even increase that 2.5 million barrel per day production average.
Where else did the capital go, beyond those Santos Basin mega fields?
Another $0.9 billion was directed toward development in the Campos Basin, covering both pre-salt and post-salt projects.
So they're not abandoning their existing hubs, they're modernizing them.
Exactly, which is evidenced by those post-salt cost reductions we saw earlier. And finally, about $500 million was allocated to exploratory investments. So they're still testing promising new acreage, just with a smaller slice of the overall capital pie.
Now, a key question for you. If they're spending $12.9 billion in 9 months, how are they financing it? Are they over-leveraging the balance sheet to do this?
The capital structure remains remarkably stable and healthy. Gross debt as of September 30th stood at $70.7 billion.
Okay.
Net debt was $59.0 billion, which is only a minimal increase of 0.8% compared to the previous quarter. They are managing this massive expenditure program without materially inflating their net debt position.
And the leverage ratios confirm that control.
They do. The net debt to LTM adjusted EBITDA ratio held perfectly stable at 1.53 times, same as Q2.
And gross debt?
The gross debt to LTM adjusted EBITDA ratio increased just slightly, from 1.78x in Q2 to 1.83x in Q3. And for a major integrated oil company, anything under 2.0x is considered conservative and highly stable.
Did the debt profile change much in terms of maturity or the interest rate?
The weighted average maturity shortened a little bit, from 11.92 years to 11.36 years, which is still a very long maturity profile. And encouragingly, the average interest rate they paid improved marginally to 6.7% per annum, down from 6.8% in the prior quarter.
Which suggests they're getting favorable refinancing conditions.
It does. And the company clearly tapped the capital markets aggressively in 2025 to fuel this CapEx drive.
How aggressively?
They took on new debt. Proceeds from new finance debt were substantial, totaling $5,315 million in the first 9 months.
$5.3 billion. Compared to what last year?
Only $1,553 million in the same period of 2024.
And where did they get the money?
The main sources were about $2 billion raised through international capital markets via global notes, and another $1.7 billion raised in the domestic banking market. This strategic financing ensures they have the liquidity to cover the increased CapEx without stressing their internal cash flows.
Speaking of cash, let's just finalize the liquidity picture.
Cash generation was the ultimate strength this quarter. We saw the operating cash flow was $9.9 billion.
And the free cash flow remained exceptionally strong at almost $5 billion, even after funding that huge capital program.
It did.
And their cash reserves act as a fantastic buffer.
Indeed. Cash and cash equivalents totaled $9.0 billion. But when you factor in adjusted cash, including readily available marketable securities, the total liquidity stood at $11.7 billion.
Plus, they have credit lines.
Untouched credit lines. Unused revolving credit facilities totaling nearly $7 billion. This massive liquidity buffer just guarantees them operational flexibility and market confidence.
Okay, let's shift gears to Section 6. Shareholder returns, equity, and compensation. This is where the fruits of that strong FCF generation are distributed.
The dividend story here reflects a real structural shift in their remuneration policy.
Yeah.
Total dividends paid in the first 9 months of 2025 were $6.6 billion.
Which is generous, but...
It's significantly lower than the $12.9 billion they paid out in the same period of 2024.
And that change is entirely consistent with their new shareholder remuneration policy. They're trying to balance the payouts with the aggressive CapEx requirements for future growth.
It's a balancing act.
How is the interim dividend structured based on the 2025 results?
The board had previously approved about $3.6 billion in interim dividends, which was about $0.28 per share, and that covered the first and second quarters.
And what about the specific 3Q25 dividend approval?
Subsequently, on November 6th, the board gave its approval for an additional $2.3 billion, which translates to about $0.18 per share.
And that's based on these strong Q3 results.
Yes, and that amount is scheduled for payment in February and March of 2026. This ongoing, even if it's slightly moderated, commitment ensures that the stock remains attractive to income investors.
The ultimate measure of success for owners, though, is earnings per share, EPS.
Right. Basic and diluted EPS improved modestly in the quarter, from $0.46 in 3Q24 to $0.47 in 3Q25.
But the year-to-date number must have seen a huge jump.
It did. Because of the cumulative effect of those massive one-off gains and FX effects we detailed, the year-to-date EPS saw an enormous jump. It was $1.30 per share for the first 9 months of 2025.
And last year.
Just $1.80 in 9M24.
Let's talk balance sheet strength, specifically total equity.
Total equity saw an impressive surge. It reached nearly $80 billion as of September 30th, 2025.
$80 billion. Up from what?
Up from $59.4 billion at the end of 2024.
That is a substantial $20 billion increase. What drove that?
It's primarily attributed to that huge net income accumulation during the 9-month period, fueled by FX gains and one-off events, as well as some actuarial gains they recognize in comprehensive income.
Which leads us to the complex topic of employee benefits.
It does. But before that, quickly on share transactions, just a housekeeping item. In January 2025, the company canceled over 155 million treasury shares.
Which reduces the share count and is a small positive move for existing shareholders. Okay, now let's tackle the complex issue of employee benefits and the healthcare plan, Saudi Petrobras, which involves some pretty intricate actuarial accounting.
This is a major liability on their balance sheet. Total post-employment benefits liability increased to $13.8 billion.
Up from what?
Up from $11.4 billion at the end of 2024. And the largest component of this is the liability for the Saudi Petrobras plan, which reached $9.3 billion.
And the major event here was the renegotiation of the cost-sharing structure. How did that impact the finances?
The company agreed to resume the 70% Petrobras, 30% beneficiary cost-sharing arrangement.
That sounds like a simple labor agreement, but its financial impact is bifurcated and, frankly, confusing.
It is. So first, the revision of their actuarial assumptions, mainly the discount rate they used to value the liability, resulted in a total comprehensive income gain of $1.3 billion.
So a gain,
Yeah.
But there was an almost equal and opposite expense, right?
Yes. The new benefit costing, which resulted from the change in the actual cost-sharing mechanism, required a related expense of nearly $1.3 billion to be recognized in other income and expenses.
So while they got an actuarial gain on the balance sheet valuation, the operational cost of the plan increased slightly due to the new agreement. It just highlights the intricate trade-offs in these labor negotiations.
It does.
This brings us to our last big topic, Section 7, the legal and contingency landscape. And this is vital for assessing the long-term systemic risk, especially for a company with this kind of history.
Petrobras carries a massive contingent liability profile. Total contingent liabilities, these are items classified as a possible future loss, stood at $41.4 billion as of September 30th.
$41 billion in possible losses. What's driving that?
It's primarily driven by tax claims, which are almost $23 billion, and civil claims, which are another $15 billion. These are claims where the company believes a loss is possible, but not yet probable.
And to protect against these possible losses, cash often gets tied up in judicial deposits.
Correct. Judicial deposits totaled $15.1 billion, mostly concentrated in those tax proceedings.
So that's $15 billion of cash that is just unavailable for CapEx or dividends. It's tied up waiting for legal resolution.
Right. And they have a mechanism, the Negotiated Legal Proceeding, or NJP, to manage those massive tax deposits more efficiently.
Can you explain how that works?
The NJP agreement with the National Treasury Attorney's Office is a highly sophisticated cash management tool. It allows Petrobras to postpone judicial deposits over a $38 million threshold by using future production capacity from the Tupi, Sapinhua, and Roncroa fields as collateral.
So instead of paying cash now, they pledge future oil.
Exactly. As of Q3, the guarantee balance held in this NJP was $2.5 billion. And this frees up cash that would otherwise be locked away in a court account, allowing them to redirect it toward their aggressive CapEx program.
Okay, now let's discuss the single most important de-risking event of the quarter, the RM&R ruling. This is huge for the long-term risk profile.
This cannot be overstated. RM&R is an acronym for a minimum compensation calculation, and this liability stemmed from years and years of legal disputes over the correct calculation of employee pay.
Then what happened?
Due to highly favorable rulings from Brazil's Federal Supreme Court and the Superior Labor Court in 3Q25, that contingent liability was functionally eliminated.
And what was the financial impact of that elimination?
The contingent liability for RM&R was drastically reduced from $4,934 million at the end of 2024
So nearly $5 billion.
to just $89 million as of September 30th, 2025.
So they removed nearly $5 billion in potential risk from the books.
Instantly. And that makes the company's stock much more attractive to risk-averse institutional investors and materially cleans up the balance sheet. This is a massive qualitative win for management.
Moving to other high-profile legacy issues, what happened with the Setme Brazil lawsuit brought by EIG?
That issue reached a definitive resolution earlier in the year. A settlement was reached on March 7th. Petrobras paid $283 million.
And that ended it.
It terminated the related U.S. lawsuit and canceled an associated asset block that had been placed in the Netherlands. It was an expensive closure, but removing a major source of litigation uncertainty is always beneficial.
Finally, the complex Netherlands class action, where does that stand today?
This litigation remains highly uncertain and complex. The Rotterdam District Court issued a ruling on October 30th, 2024. Crucially, the court rejected claims made under Brazilian and Argentine law. However, it did find illegal action under Luxembourg and Dutch law concerning certain bondholders.
What's the implication of that partial ruling?
It was a declaratory decision. That means the court said there was an illegal action, but it didn't assign any damages.
So it's still up in the air.
Very much so. The case involves deep complexities about arbitration clauses and who could even be a beneficiary. Petrobras is appealing and continues to vigorously defend itself. But since the quantification of damages is so uncertain, management can't assign a probable loss estimate. It remains a persistent, yet unquantifiable risk.
We have covered a vast amount of complex material here, moving from daily production records to multi-billion-dollar legal liabilities. Let's try to synthesize all these findings in our final section.
The 3Q25 results really present a clear picture of resilience, a resilience driven by operational momentum. Management successfully counteracted that $11 per barrel Brent price drop by focusing intensely on volume and efficiency.
And they delivered. They achieved record production over 2.5 million barrels per day and showcased peak performance at key assets like the FPSO Almirante Tamandaré.
And financially, while the operational numbers held up, the net income was truly amplified by significant non-recurring factors, making 2025 look exceptional on paper.
Right. That extraordinary 9-month net income was massively boosted by favorable foreign exchange gains on the real-to-dollar parity and those strategic accounting moves.
Specifically, the $289 million impairment reversal at the Boaventura Energy Complex, which confirms the long-term value they see in integrating their downstream assets.
And from a risk and valuation perspective, I think the most important takeaway is the dramatic de-risking of the balance sheet.
The colossal reduction in contingent liabilities due to those favorable RM&R legal rulings, a near $5 billion reduction in potential risk, is the true financial victory of the period. This event significantly lowers regulatory and labor uncertainty, improving the overall liability profile for years to come.
Finally, we see a company that is executing a clear dual strategy, aggressively funding the future while still maintaining significant shareholder returns.
Absolutely. The company successfully generated nearly $5.0 billion in free cash flow in just this quarter, while simultaneously committing almost $13 billion in CapEx for the first 9 months.
And that investment is predominantly targeted at ensuring pre-salt growth through 2027 and beyond, particularly those 225,000 barrel per day Buzios FPSOs.
That aggressive investment confirms that the future of Petrobras remains centered on maximizing deepwater exploration and production.
That focus on massive future production capacity, funded in part by favorable financial conditions and a cleaner liability slate, really defines the outlook for Petrobras. The question for you, the investor, is whether they can sustain this level of investment and operational efficiency until 2027, when those multi-billion-dollar FPSOs finally come fully online and begin producing returns.
The cash is there, the projects are approved, and the legal hurdles are clearing. Now it's just a matter of execution.
With that, we conclude our coverage for this video. Thanks for joining us. Sheen Research, Mindful Markets, Measurable Meaning.